Welcome to an in-depth analysis of the monumental milestones recently achieved in the financial markets, focusing on the Dow 50K and new S&P 500 records. In this 6 to 8 minute video, we'll break down the massive shift known as the defensive sector rotation and explore Wall Street's audacious long-term target for the S&P 500 at 8,000. The financial world is celebrating the Dow Jones Industrial Average, hitting the historic 50,000 milestone, alongside continuous record highs for the S&P 500. This is a moment of triumph, but also complexity. Despite these soaring indices, market sentiment shows caution. We're seeing a notable and massive rotation of capital away from high-growth stocks and into defensive sectors, indicating investor uncertainty about future economic stability. Let's put these achievements into historical perspective. The Dow 50K and S&P 500 highs didn't happen overnight. The journey to Dow 50,000 is a testament to long-term market resilience, driven by innovation, corporate earnings, and evolving economic structures. It's a powerful visual representation of compounding growth. The S&P 500's record run is primarily fueled by a handful of mega-cap tech companies, strong corporate profitability, and generally optimistic forward guidance, despite underlying economic concerns. These records are largely underpinned by favorable macroeconomic factors, particularly accommodative central bank policies, which have kept borrowing costs low, making equities relatively more attractive. Now let's turn our attention to the massive defensive sector rotation that is dominating current market movements. Defensive sectors typically include healthcare, utilities, and consumer staples. These are industries whose products and services maintain demand regardless of the economic cycle, offering stability during volatility. Recent data clearly shows substantial capital flowing out of high-beta growth stocks and into these traditionally defensive sectors, signaling a shift in investor risk appetite. This rotation is largely driven by a flight to safety. Investors are increasingly concerned about high valuations in tech, inflation risks, and the potential for a growth slowdown, leading them to prioritize stability over aggressive growth. Let's take a closer look at what makes these defensive sectors so attractive right now. The healthcare sector, for instance, benefits from demographic trends like aging populations, continuous innovation, and often lower sensitivity to interest rate hikes, translating to solid performance. Utilities and consumer staples are sought after for their reliable dividend yields and inelastic demand. People need power and basic goods no matter the economic climate, making their earnings highly predictable. Finally, let's explore a long-term perspective, Wall Street's journey toward the ambitious S&P 500 target of 8,000. While 8,000 seems distant, many analysts see this as achievable within the next decade, provided certain macro conditions align. This projection is based on historical growth rates and forward-looking economic models. To reach 8,000, we need sustained double-digit earnings growth across the index, combined with a stable to lower interest rate environment that supports higher valuation multiples. However, potential headwinds exist. Persistent high inflation, aggressive tightening by central banks, geopolitical instability, and unforeseen economic shocks could significantly derail this long-term trajectory. To conclude, the market is in a fascinating duality, celebrating historic highs while rotating defensively due to underlying caution. The defensive rotation underscores the importance of stability in volatile times, reminding investors that preservation of capital often precedes aggressive growth. Whether aiming for 8,000 or navigating current volatility, a balanced investment strategy, attentive to both growth potential and downside protection, remains paramount. Thank you for watching.